Welcome everyone who's joining. I just wanted to say again, we are waiting a few minutes to let people in. We are also streaming on Facebook. And if you want to share anything about who you are, where you're calling in from, feel free to share that in the chat. Okay, I'm going to kick us off, and if more people join us, then that's great. Thank you everyone who has joined, and thanks for also sharing a little bit more about where you're calling in from. Feel free to drop that in the chat. We have three incredible speakers today here to talk about why divesting is a good investment strategy. I'm Sanchali. I'm Princeton class of 2012. I'm a climate entrepreneur working in the Bay Area. And so I'm personally really interested in this space and excited to speak with each of our guests today. I want to open our discussion first with a land acknowledgement, which we do at the beginning of each of our Divest Princeton discussions. We'd like to acknowledge that Princeton University sits on land forcibly taken from the Lenni Lenape tribe, and that if it weren't for the pandemic, perhaps we would be meeting on campus to have this discussion. We also want to acknowledge that the pandemic and the climate crisis are intertwined, and racial justice and social justice and climate justice are all important parts of the same problem. All of them exacerbate systems of oppression, which impact Black, Brown, and Indigenous people disproportionately. So just want to start us out with that acknowledgement. And also to ground us in the content of this talk. So today we're here to talk about the financial reasons for divestment and whether it makes good economic sense to divest. Just to sort of put some context on this discussion, I thought I'd share some data. Global stock indexes without fossil fuel holdings are currently outperforming identical indexes that include them. Reporting from The Guardian in 2018 said that investors who divested from fossil fuel companies would have earned an average return of 13% a year since 2010, which is higher than the average for conventional investors, which is 11.8% year on year. So we're starting to see that backed up by data. We're also starting to see many universities begin to divest from fossil fuels, and many of them are citing financial reasons as the primary reasons for that divestment, including recently, last year, the University of California system, which basically came out and said that fossil fuels pose a long-term risk to strong returns for the University of California system's portfolio. So just sort of grounding us in that context and opening up this space to talk about why divestment is a good investment strategy. To introduce our three guests, I'll start with Randy Altshuler, who is class of 93 at Princeton. He also has an MBA from Harvard Business School, and he is the founder and CEO of Xometry. Is that the correct pronunciation?
It's perfect, Xometry, like with a Z, yeah, perfect.
So Randy is a multiple time founder and entrepreneur, a business builder, and will bring a lot of experience from that space. Marilyn Waite, who leads the climate and clean energy finance portfolio at the Hewlett Foundation. She was Princeton class of 2006. She also has a master's degree from the University of Cambridge and has worked in climate investing, especially with entrepreneurs, for many years. And Mick, who is class of 2009 at Princeton, and also holds a master's from Cambridge, is the co-founder and CEO at Vestiv, which helps people think about how they should invest their money sustainably, but I'm sure he'll do a better job explaining that than I did. So I'm going to pass off to each of you guys in turn and ask you to take a few minutes to just respond to the idea, how do you think about if divestment is a good investment strategy? I will start with you, Randy.
Well, great. And it's terrific to be here today. And I'm so excited that we're having this conversation and that this movement exists, because I think this is not only important, obviously, for Princeton, but it's important for all of us as human beings and for some of us as parents and people who care deeply about our planet. I am an entrepreneur. I've been one for a long time now. So I take a very practical approach to thinking about sort of these kinds of problems. And I also think about where is their value. So I start companies, as you mentioned, this is my third company, and I start companies thinking about where is there the opportunity to create something new, something incremental, something that's valuable to reward both my investors, but also my employees and the greater community. And if you can get the three of those things together, you can make your investors money, you can build a great company for your employees, and you can actually do something good for the greater society. It's like it's a home run. For me, climate change and both the positive and negative side is one way to do that. So the negative side is by Princeton investing in these old industries, these industries which are literally poisoning and destroying our planet. Princeton is betting against what is common wisdom that we need to move beyond those and innovate. So at the end of the day, one way or the other, we're going to have to find a way to limit carbon emissions. We're going to have to limit what a lot of these companies are doing, which is going to have a lot of downward pressure on these companies, just like tobacco companies. Eventually you knew they were going to be in trouble. So those are bad investments for Princeton. And then you flip it around, if they took that same capital, and some of my co-moderators today are doing this, if they're investing that capital into startups that are actually trying to solve the problem, the returns there are infinitely higher. So do you want to invest in a dying industry, or do you want to invest and create new jobs, create greater return, and save the planet while you're at it? To me, it's a no-brainer. And I'm looking at that just purely as an entrepreneur and as a business person.
Thank you. Marilyn, do you want to go next?
Sure. Can you hear me?
Yeah.
Great. AirPods are working. So I'll start with three highlights of the financial case for divestment. So the first you mentioned earlier, which is that fossil fuels pose a long-term, actually I would say short, medium, and long-term risk to generating stronger returns for a diversified portfolio, period. In the last 10 years, the S&P energy sector, which is code for coal, oil, and gas, gained just 1%, whereas in the same period, the broader market gained 212%. So there's a clear business financial case against investing in fossil fuels. The second thing is that we actually have case studies that illustrate the power of divestment. And so there's one recent example where all the major US banks divested and said no to banking or financing drilling in the Arctic refuge. The Trump administration had an Arctic refuge lease sale, and it was a big flop. So only half of the leases offered were sold, and only 2 small companies in the state of Alaska bought leases. The total revenue was less than 1% that the Trump administration had promised. So clearly, divesting from fossil fuels makes financial sense, but it also impacts the projects on the ground, moving us towards this climate-friendly economy and society that we need. The third thing that I'll mention is that banks and asset managers are already moving at this pace and increasing the cost of capital for climate causing industries, including fossil fuels. So if you look, there's a great study by Redburn in 2019, which shows that the return on investment capital is very low for fossil fuels across the board. And thus, the hurdle rate is higher when it comes to financing a coal plant. So we're looking at a 40% hurdle rate for coal versus 10% for developed market solar and wind. So all of these things point to the same conclusion, which it makes no sense to keep investing in the fossil fuel industry.
Thank you, Marilyn. And Mick.
Yeah, sure. So just want to echo some of the comments, that really excited to be here and love that something like this exists, and we kind of get the chance to get together and talk about this because it is so important. I'll just touch on my background real quick, which is I'm the founder of a company called Vestiv, and we create software that helps wealth management firms evaluate the environmental and social impact of their investments and how to move their investments into a higher impact strategy. And before I did that, I worked at Morgan Stanley as a portfolio manager there on the institutional level, creating climate conscious portfolios for institutional clients. So I come at it from a very portfolio management perspective, and I guess I'd put it in a couple different ways of why I think divestment is a good investment strategy. And one is very similar to kind of what the other panelists have mentioned, is thinking about where opportunities are, especially for when you're someone like an endowment who has a very long-term time horizon. It doesn't have strict benchmark restrictions. You can think about where the biggest opportunities are. I think the other thing too that a couple of folks have already touched on is looking at the fossil fuel industry as a dying industry, which it absolutely is. That has knock-on effects from a portfolio management perspective. The fossil fuel industry is highly tied performance-wise, financial performance-wise, to commodity risk. So you're overexposed to commodity risk. They're highly levered as companies. So if you have a financial crisis, you see the impact of that from financial returns perspective. There's, I guess, a number of different reasons why it makes sense, both from trying to create upside in your portfolio as well as trying to minimize downside. And the minimized downside is arguably probably even a bigger argument. You've seen it, in April of last year. Energy underperformed. Or traditional energy underperformed. You saw it in the energy crisis a few years ago, same thing. So there's just a lot of different reasons, purely just from a financial perspective. There's a lot of data, a lot of studies out there. And then I think on top of that, you have the moral argument that, you can have an environmental and social impact with this capital without sacrificing financial returns. And that to me really speaks the loudest. So a number of different reasons why I think divestment is a great investment strategy.
I think all three of you have hit on some really important points on why divestment is a good investment strategy. But I also just want to open up the real discussion that I think skeptics have for, isn't it, there's this argument that people say, isn't it more effective for the university to influence fossil fuel companies as a shareholder than as an organization that divests? How do you think about that question? Why is it effective or important for us to think about divesting rather than being shareholders of fossil fuel companies?
I can start. So unfortunately, our endowment is not that big. So we're not necessarily like a universal owner. We're not a big pension fund. We're not State Street, BlackRock, or Vanguard. BlackRock alone has $7 trillion. In general, university endowments are in the billions, if you're lucky, if you have big endowments. And so it doesn't have that same weight as a single engagement strategy. So that let me just throw that out there as just the pure numbers. Anyone else want to come in?
I can chime in on a couple different things on this. And I guess, one is, I think from a pure numbers perspective, unless you are a really, really big player and it's very top heavy, you're going to get outvoted if you're just trying to proxy vote. I think the share advocacy argument to me is more of, let's get attention on this issue. And you can do that a number of different ways. And I'd argue that the multiplier effect by the media attention from a divestment strategy is arguably the most powerful piece. And I think that the attention that you gain from that as opposed to being one question at the end of a quarterly conversation with the management team or a potential proxy vote. I think the one clearly outweighs the other. So I would kind of throw that out there as my counter argument.
I'd also say that an engagement strategy is useful when there's a viable path to decarbonization. So you can engage with an automobile industry or company because they can start to manufacture electric vehicles and electric trucks and things of that nature. So there's a viable pathway, whereas I think for a lot of this, there isn't that viable pathway. And so you have to really have a really big stretch of the imagination to imagine that this entrenched industry is going to somehow do a 360 and become a renewable energy powerhouse for wind, solar, geothermal, and all of the rest of the technologies that we have on the table. So I think there's also that reality of engagement versus divestment and investment.
Yeah, I think the signaling effect is really important too, that Mick mentioned, is that one investor alone is very unlikely to shift an entire market, but the signal that many investors together can create, especially many investors who have a high external profile, and Princeton University is certainly one of those institutions who has, in some ways, also a moral high ground as an academic and teaching institution, as many universities do, to sort of raise attention to the issue of why it might be a good reason to divest. Sort of a related question, while we're talking to the skeptics, does divestment clash with a firm's fiduciary duty? This is something we often hear in the financial space, that if we're risking financial returns, then that's going to conflict with a firm's fiduciary duty.
Well, I think, and I know Mick and Marilyn may have better data on the how those stocks are performing, the fossil fuel stocks are, but I will tell you, if the university is trying to maximize the return of its portfolio, electric vehicle companies and others have got unbelievable valuations, and investors in those companies, both early and even at later stages, have made outsized returns. So if the company's real bottom line here is to maximize its profit, then investing in alternative energy sources, in green technology, can be wildly profitable. Now, some people may say, well, those are riskier. Well, of course, the university is going to have a balanced approach, but there are plenty of blue chip stocks, stable stocks they can invest in that create that certainty for them that don't include poisoning our planet. And so they can fill that bucket and check that and have some risk, though, on this side without doubling down on that industry, which is just not performing well, versus all these sort of electric vehicle makers. There's one called App Harvest, which is went public via SPAC, that's creating these giant greenhouses using recycled water. You know, these are amazing investment opportunities, and they're great for the environment too.
I think sometimes I think the putting any constraint on a portfolio is harming it, is a little bit of flawed thinking. Like, you know, think about it as a reallocation, right? Like, people didn't say, oh, you allocated a bunch to venture capital and private equity because those have higher returns. Are you harming yourself because you're reallocating from public to private? No one says that, right? And so I think about it as a reallocation, like we've mentioned it, right, from industries that we don't think are great investments from both a purely financial perspective as well as from an environmental and social perspective, and we're reallocating to things that we do believe in from a both financial and environmental and social perspective. So it's also like you think about sufficient diversification in a portfolio, and the percentage of the overall market that fossil fuel companies make up is a very small fraction of it. And you're not preventing yourself from having sufficient diversification. You can look at it, diversification, in a bunch of different ways, but very common one is kind of risk factors and trying to replicate the market, and you can do that very easily while still eliminating kind of the worst actors.
How do you think about the role of investors in general in shifting society and economies away from fossil fuels, especially private investors? And as sort of an extension of that, you could think about it, how do you think about the role of businesses? But first, how do you think about the role of investors in helping society make that shift?
I guess I could tackle this one as well. I think it can be large, and I think we've touched on a few different ways. I think Marilyn mentioned the cost of capital. Randy has talked about putting capital to businesses that need capital. As an entrepreneur myself, I understand the importance of having capital. So I think those arguments are true, but I also think that the signaling effect and kind of the media attention effect is also huge as well. And the fact that if you read any investment news site these days, there are talks about divestment and ESG, and it's impossible to ignore. And I think that has a huge effect. And I think that companies, you look at the hiring job postings of any company these days, and they have a sustainability manager. These are the jobs that are being hired. These are the roles that are being created. These are the dollars that are being allocated. And I think that the investors, retail and institutional, have a big part to play in it, both from the capital allocation, the cost of capital of the different companies, as well as just contributing to the overall conversation and moving things forward.
So I'll add before Randy jumps in. The one thing that I would also mention, so whether you're like a lender in a bank providing credit, lines of credit or loans, or you're a retail or institutional investor, mostly on kind of the equity side, you can actually engage with the companies, get the data that you need to measure, disclose, and reduce the finance emissions. So those are the emissions associated with your financial asset classes. So for each financial transaction, what are the tons of CO2 equivalent? And how do we track that year by year? And how do we move from the high emitting to the low emitting systemically? And so that's something that PCAF is doing, the Partnership for Carbon Accounting Financials, a bunch of banks and asset managers globally coming together to measure, disclose, and reduce their finance emissions. And so as an investor or lender, you can join that, you can make that transparent, and then you can have that kind of influence on the entire system, because what's going to happen is as you agree to measure, disclose, and reduce, so does the real economy, especially for lenders.
I think that's great. So I think one of the problems here when you talk about investors, because I've raised a lot of money, and so I despite what you would think, and I play a lot in the venture community, I deal with a lot of venture community, there is not a flood of capital to green companies or companies that are fighting climate change and these things. And that's because their primary mission, forget about investing in oil companies, or their primary mission is to maximize their returns for their investors. And so, well, I think the case is easier to make the case that Princeton shouldn't invest or investors shouldn't invest in Exxon. I think it's harder to make that case right now that they should invest in emerging green technologies, because I think the problem is that it's a free rider problem, right? So there's really no cost to polluting the environment today. So there's this, when you order from various places, whether or not it gets shipped from China or gets done locally, the additional cost of that isn't actually factored into the transaction. So it becomes morally, you can say, hey, I'd rather buy it, the true cost is cheaper to buy it here versus there, because it's going to get in an airplane and all these different things. But that doesn't really translate today into dollars and cents. So I think before the government actually comes in and levies taxes on these things and actually calculates and forces that to be part of the equation, I think investors will not throw in as much as they could. So all the ESG, all these things are wonderful and they're the right steps, but that will clash with where am I really going to put my money and how am I going to maximize it? There's no real cost for pollution, or if one company being better at that than the other doesn't add to any bottom line, it's harder for them to really dissect that. And I think that's where the government has to help business here see the way. It cannot just be a pure business solution. We just won't get there, not fast enough.
Yeah, I think that's a great point. Personally, also as a early entrepreneur in the climate space, I think investors have a big role to play in encouraging entrepreneurship and businesses to play in a space where they might not have been willing to in the past, where there wasn't as much capital. Although we still need to see a lot more capital coming into the space of investing in green technologies, there has been a significant increase in the last year or two in interest. And for instance, for me, our lead investor is Sequoia, and seeing Sequoia Capital make a major investment in the climate tech space, I think is a signal for other entrepreneurs to say, hey, climate tech is not only an impactful place to build a business, but also potentially profitable. And there's capital at scale that's willing to go there. And the more investors, endowments, capital of different sizes are willing to make those types of moves, I think the more that we'll see companies also move in that direction. But of course, policy, we can't ignore policy. It's incredibly important for setting the stage.
I think the other thing, especially for early stage investors and venture capital investors, there's often you take board seats or you're a board observer. I think informing the early stages of a company and their policies around this is very important. So ensuring that when they open up this bank account that's receiving the investment, is it a climate friendly bank account? Is it a climate friendly bank? Are you banking with JP Morgan Chase or Amalgamated? There's a list goes on and on. Retirement benefits for the employees. When that first gets established, the 401k, is it a climate friendly one? And so these things really matter. And so if you are early stage investor, including in climate tech, take a look at those things for your portfolio companies. It's important, and that's how we can change the system as well.
Absolutely. We actually we're setting up our first 401k as of March 1st. And we just switched banks to a bank for our company that's divested from fossil fuels. And we left Bank of America, and they said that they had never had a small business client leave them because of their investments in fossil fuels, not that they could remember at that branch. So I hope, maybe we're really small fry, but if more investors could make sure that their companies were doing it, I hope that would make a difference. I wanted to also think about, we've talked about investors, we've talked about businesses, but we also are all people who have investments. And so you started talking about this a little bit, Marilyn, our 401ks, our banks that we use. These are ways that we personally are invested in fossil fuels and we might not even realize it. How should people who are interested start thinking about divesting their own money from fossil fuels? And does it matter?
I feel like Mick was going to go, but I'll go first. It does matter. So in the US alone, there's about 12 trillion of bank deposits. I know that a lot of the major largest banks in the US, some of them are 60% retail, 40% institutional. So we're talking about a lot of capital that is sitting in our bank accounts as both consumers, households, and as small businesses. So yes, it matters. That's not even including the retirement space. That's just, checking and savings, money market accounts, things of that nature. So yes, it matters. And so there are a number of tools, websites that can help you choose a climate friendly bank, a bank that is at a minimum fossil fuel free, but also hopefully also will invest in climate solutions. Clean Energy Credit Union is an example. So the credit unions, they're banks. There are other, fintech companies like Aspiration, Ando, Atmos. There's a new bank coming out in Florida called Climate Bank, I believe. There's just more and more options. And so there is on my website a list of these banks. There's also bankforgood.org as a collection of banks that are climate friendly. And you can actually filter by a number of other impact metrics in addition to climate friendliness. And so it's there. On the kind of retail investment side, there are also a number of advisors, robo-advisors, wealth managers that specialize in making sure that it's climate friendly. Some of these new tools include Open Invest, Carbon Collective, New Day. There's particular products like ETFs, including Etho Capital and Adesina, Social Capital's ETF. Anyway, there's no shortage of products now and ways, and it's actually quite within your grips, very easy to access at this stage as a retail investor and a retail saver for a bank account.
Yeah, I just want to add maybe a couple other things to, but I think Marilyn did a great job of laying a lot of it out, and that, 10 years ago, maybe it would have been difficult for a retail client to, say, hey, I want to be more conscious with my dollars. But these days, there is a lot of options. I think that you guys brought up a great point that honestly, a lot of people blow completely past, which is, and they say, oh, I have my money in my bank account. I'm not actually invested in bad stuff, where people are naive to the fact that those banks are loaning out to lots of different companies. So I think just recognizing that point is a huge one to a lot of folks. I think for people who are very interested, I think that there are a lot of financial advisors that focus on this. There's a lot of kind of DIY investment platforms. You can look up ETFs, and there's more, and one of the difficulties is there's not necessarily transparency in terms of every firm has their own impact report. And actually, that's what my business helps people figure out, is helps them understand, okay, green ETF XYZ and low carbon ETF ABC. What does that actually mean? What are they invested in? How much is allocated to renewables, and what their carbon footprint is? All that stuff. So I think we're working towards where that information is available on every investment platform that you might use, and every financial advisor. We're not quite there yet, but we're working towards that. And I think low cost ETFs that kind of focus on those things are widely available wherever your investments are. I'll echo the 401k one. That is definitely an uphill battle, and one that is tricky, and sometimes you don't have a lot of choice over, but I think that there are slowly having inroads being made there.
I want to ask one more question and then start to open up to questions from people who are listening in. My last question is about advice for the university. The university, if they would like to divest from fossil fuels, I think their next question is going to be how, or how should we think about divesting from fossil fuels? Any advice that you have on how they should think about that question? What does it mean to divest from fossil fuels as an investment fund?
I could start. I think that there's a lot of different ways you can define it. I think Marilyn brought up this point earlier in terms of one of the benefits that investors can make is demanding transparency. So it's funny these days, the low bar that is set for transparency, and like a lot of ESG funds give huge scores to companies just for simply reporting, even if their numbers are terrible. And I think that we're seeing momentum behind creating national and international standards behind what is required to report. But nonetheless, right, the fact that there isn't much transparency behind it, I think is probably number one. I think the second thing in terms of the actual investment strategy, a lot of, maybe this is controversial, I don't know, but there are layers to this, or levels, and I think that there are some very obvious low-hanging fruit. Some of these companies, I think some of the other panelists mentioned, their business is set up such that there is no path forward to potentially improving their environmental impact. And those to me seem like obvious ways to to start the divestment process. I can understand that there are some companies with a little bit more nuance where they have a portfolio of lots of different, and maybe their traditional to renewables ratio is good for the utility company, that it's good for their industry and they're on a path forward. I can understand that maybe there's some questions there, but there's definitely some very obvious places to start. And some folks want to push for everything, and I totally understand that. But I think transparency and starting with the easy places should be steps 1 and 2.
I agree with Nick. I mean, it's easy to make some quick changes and some quick wins. I also think the university endowment isn't trying to optimize for 20 basis points or 30 basis points. So to create some sort of ridiculousness about how they have to do, we're going to wait a long time so we can do this perfectly right and make sure we don't lose any yield. I mean, that's just kind of silly. And then I also go back to what I was saying before, which is whatever additional yield they may get by making this process take 6 months or a year versus 2 months is pales in comparison to the damage that these companies are doing. So, I think, again, let's just let's get going, and we can fix it later on. But as Mick said, there are levels and layers, and let's hit that first one, and then you can get lower and lower as you go on. But you can start tomorrow, and there's plenty of liquidity. There's plenty of things you could do that wouldn't be controversial and would be effortless to execute.
Yeah, I think that's a great point. We can't let perfect stop us from starting to divest. There's so many, obviously fossil fuels are embedded in almost every part of our economy. So it's nearly impossible to completely extract ourselves from any byproducts of fossil fuels, but it's pretty straightforward to start divesting from the worst offenders. So I think that's a really great message. I'm going to start picking out some questions from the chat, starting with Pallavi's question. Should universities accept research dollars or grants from fossil fuel companies? This has been particularly controversial, I think, with Princeton, most notably accepting a lot of research money from Exxon, but also from other fossil fuel companies. And how do you think about that question?
I wouldn't do it. I think you're sending a very mixed message. And I think the integrity of the university, if they decide to divest, which I think is paramount, then how can you take money from those same institutions? I think, and again, you can get down to many little layers, so let's not make ourselves crazy. But if it's Exxon, then that seems like a low-hanging fruit. And so, again, we don't have to make this some insane thing, but you can start pretty easy. And I just don't know the hypocrisy of doing one and then the other at the same time. It's not fair to anybody. It sends a very mixed message.
I think it's particularly difficult when those organizations are funding our energy and environment research. Are there any other universities or institutions that you look to as a model for successful divestment? Are there maybe universities, maybe not universities, maybe even, I don't know if Ford Foundation thinks about this, but other organizations you've seen successfully execute divestment strategies?
I could touch just briefly from my life in the institutional investing world, which can't name names specifically, but just in terms of trends, I think what we were talking about earlier with the different levels of reallocation, divestment, and how stringent that is. I think we've seen that escalate over the past 5 years or so, and I think that interestingly enough, like in the institutional world is by far leading the retail world in terms of how their thinking on this is evolving. I also think that in terms of looking for examples, Europe is definitely ahead of where we are in the US. So not necessarily citing any particular companies or pension funds or any endowments or anything, but I think that in general, we have looked to Europe as good examples in terms of leading this change.
And I don't know any examples of an institution or even retail investor that is divested that has tanked or lost out. So the opposite, if you look at the opposite way, I just can't think of any examples of this flopping in any shape or form. It wouldn't make sense. I mean, what Mick is mentioning is just actually, if they're doing well, it's likely that they are divesting already because of the market, the way the prices are working in this sector. It would just, if they're having great returns, it's not due to the oil and gas and coal sectors.
Yeah. Also, I realized I said Ford Foundation before I meant Hewlett Foundation. Has the Hewlett Foundation divested? Is that public?
No, we have policies like no upstream oil and gas drilling, no more coal in our private equities, but we haven't made announcements as other foundations have. Our returns and our full investment strategy is all private, not public, but we have certain things that are public around certain guardrails. We also have like no tobacco, which is legacy kind of investment policy.
That's a really interesting approach. And I think a really practical one, kind of what Randy was describing, is maybe we could start by just putting up guardrails and saying, there's certain things we're not investing in, and being very clear about that. And that can be an easy first step. Do you have any thoughts about the timeline for divestment? I feel like, Randy, you're also touching on this, is, organizations, universities like to take a long time making decisions, potentially. How do you think about how quickly divestment can happen?
Well, I think you opened this meeting by talking about the linkage of our ecological policies and divestment with underrepresented communities, their impact from things like COVID and from other events, making sure. So at a time now when there is such an outcall or outcry for racial justice, where there's so much awareness around this is the time to seize the mantle, because it is an intertwined story here. And the university in many ways has moved very quickly in that front, and good for them. This is the same thing. And in fact, this is something that literally impacts every individual in our entire world. So I don't know why they wouldn't do this tomorrow. I think if the university is seizing the high ground on so many other issues and being bold and taking initiative, which is wonderful, this is part and parcel with it, right? Who is getting hurt most by these problems, the fires, all these different upheaval? It's the disadvantaged communities, the communities that can least afford it, that already are facing huge obstacles. If that's truly what you care about, this has to come right with it. And there is no time to waste. I always feel like I'm older than the rest of the people in this panel, but when I was growing up, the first Superman movie came out, and you had Marlon Brando, who was on Krypton, telling them all this planet's about to blow up, and they were sort of, wearing these in some elaborate justice thing, and they were dealing with all this stuff. Meanwhile, it's like, we're all going to die, the planet's going to blow up. So there is that sort of sense of urgency right now, and I can't believe the university doesn't just take some of these easy, low-hanging, as Mick said, that layer. It should be, you could do it right away. And to trade these stocks and move out of these positions, that is super easy. We are not BlackRock, where there's some magnet, you got to file with the SEC of 5%, you've got a 5% position. I mean, nobody cares. So the university can care, create that higher moral ground, seize it right now in this construct.
I think just to add to that quickly is, again, I think, it would be very easy to set out a plan of saying, hey, our liquid investments, our public markets investments, those can happen tomorrow, right? Or very short period of time. I understand that endowments intentionally make a lot of illiquid investments, and so okay, but put together a plan of saying, okay, we're doing this tomorrow. This might take 2 years because these investments are here. These might take 5 years, but like that's the general timeline of what I think would be reasonable but putting that out there and making and saying, hey, we're committed to this timeline by taking that first step on the piece that doesn't have problems in terms of a timing or an illiquidity perspective. I think to me seems like the obvious path.
Yeah, and we're talking about pretty short time periods. I mean, some of this stuff can be done immediately, and then the longer investments, we're talking about a couple years, a few years at a time, maybe for the most illiquid investments. In the grand scheme of things, those are pretty rapid timelines that we could move on, sounds like. We have a couple questions here about the impact of divestment. And I don't know, maybe there's a couple ways of thinking about this. One is how might Princeton be able to estimate the impact of their divestment in terms of climate outcomes, and how might they think about measuring that? Do we measure this in CO2e, or how do we think about measuring the outcomes? And then how do we think about what Princeton should be tracking in terms of the impact on the endowment, the financial impact on the endowment? I mean, returns are obviously one way of measuring that, but are there any other types of things they should be thinking about measuring?
I mean, I feel like Sanchali, you should be taking the how do you quantify the impact of this question. But I get there's a lot of different ways, and it's both art and science in terms of measuring impact. But we've come a long way. I think for some of the more typical investments, it's fairly standard, and you have impact reports from all sorts of different funds, and some of that data is out there, and there's a few kind of data providers that all kind of make sense. So you can create a lot of interesting kind of equivalencies in terms of making it relatable and making it mean something to all the stakeholders involved in Princeton's endowment. But yeah, in terms of kind of quantifying, whether it be CO2 or whether it be dollars allocated or whether it be put into something, equivalencies and things like that. So yeah, that would be my 2 cents there.
I have to say, I worry a little bit about, how much poison is enough poison, or too much poison, and I worry about, for some of these issues, it is so black and white to me, so clear about what should the outcome be. For the university I think for us to be obsessed too much about the calculation of it can create an argument and a discussion and wasted time on things that frankly don't matter. So, and again, I don't know these tools nearly as well as Marilyn and Mick, but there are probably some tools that take a very, gross level at it and do that, and that's probably just enough. But I think we just don't want to get into an argument about how much pollution is okay, right? We think no pollution is okay. So if there's a tool to immediately chop off the biggest pollutants, the people who are most contributing to climate change, let's do that. And the university believes in science. That's a great thing, right? They're fact-based. So I think we all assume we know that humankind has an impact on our environment. So let's react to that and do the right thing. It just seems so clear to me.
So I would say that the asset owner, manager, banking communities are aligning around net zero by 2050. The Paris Agreement is, I guess, less climate forward than that. So as we go into Glasgow, the next milestone for global climate negotiations this year, that will be the framework, net zero by 2050. And I hope that's not an excuse to do nothing until 2050. That means we track year on year, are we getting there? And we have intermediate goals before then, so that we reach there, because that's what we have to do to kind of keep this planet going. So that means all of these investment portfolios need to also align with that, having a net zero economy, carbon neutral economy by 2050. And that must mean we have to know how much tons of CO2 annually, so that there's some accountability, and that goes back to the transparency part. That's why that's important. I have no doubt that the university's investment managers are tracking all of the financial metrics, and I'm sure they have it down to a wire in terms of liquidity and the timing of investments and timing of returns and all of that. I don't think that is a problem area for the endowment.
Yeah, I'm going to also weigh in my 2 thoughts on this question, and then give each of you a chance to close out with a final thought. If you want to just think for a second about what final piece of advice you'd leave the university with as they think about whether or not to divest from fossil fuels. But as Mick said, I spent a lot of time thinking about measuring the carbon footprint of different financial flows, specifically based on a person's spending. I think what people don't realize is that all of our carbon estimations we have at the country level are based on financial flows. We estimate the carbon footprint of the United States based on the GDP of the United States and the carbon footprint of different inputs to that. So there actually is a lot of data, a whole body of research that's been going on for decades on how we estimate the carbon footprint of different countries. And a similar type of approach can be applied to the carbon footprint of different investments. And so there are many tools that are trying to do that already, but I think also to Randy's point, it's more about transparency and getting it relatively accurate rather than trying to be perfect. We see this all the time. In my world, I think about like the carbon footprint of one type of beef versus another does not matter. The carbon footprint of beef versus chicken is what matters. And that's the relatively more important choice we need to be worried about. And so I feel like the analogy here is it doesn't necessarily matter if investing in BP or Exxon is less bad. What we know is that investing in producers of fossil fuels is creating lots of negative effects and is financially maybe a bad choice. So I think those are sort of some of my takeaways from what you guys were discussing. And I think to just close out our time, I would ask each of you to just leave us with sort of your last summary thought for the university as they think about divesting. Randy, I want to start with you and we can go around.
I think a lot of alum are afraid to speak up because, I've got 3 children, and candidly, lots of people who've got children want their kids to go to Princeton, and they don't want to be troublemakers, and they don't want to, be on the record for these sorts of things. But I think we have a responsibility, both as alums, as parents, to share with our fellow alum and parents that this needs to override that concern. And if there is not a planet that we can live in, it doesn't matter if your son or daughter gets into Princeton, it's not going to be anything here for us. So I think we have to encourage everybody we know to sign up for this. I think this call is great. I wish there were 1,000 people on the call. And I bet if we pick some other topics, there would be. This topic needs to be as urgent for people as anything else that we're talking about today. Our lives depend on it, and our future generations depend on it. We all need to go out to our friends and family who are related to Princeton and urge them to urge Princeton to do the right thing.
Marilyn.
So I studied civil and environmental engineering at Princeton. And so I was definitely trained to do exactly this in terms of being an environmental steward in my career. So I would say that this is very Princetonian in terms of driving divestment, away from the things that harm the planet and people, and driving investment into the solutions, including technological solutions that often come from university spinoffs. So there couldn't be anything more Princetonian than this effort.
Mick.
Yeah, I think that I like what both the other panelists have said, but I'll also reframe it a little bit in saying, I don't think we're being agitators necessarily, and I think that we're helping shine light on something that Princeton at large and the Princeton Endowment should be paying attention to, and we're trying to help them be a leader in this and have credibility. And I think that increasing transparency and taking the right first steps would be the best way to do what I think is best for the Princeton Endowment and all its stakeholders.
Thank you three so much. All of your perspectives have been incredibly insightful, and I think your experience in different parts of business has been really, really helpful to all of us. So thank you for taking the time, and everyone else, thank you so much for joining and sharing really great questions. And we'll have this recording up online so more people can see it soon.
Thank you so much.
Yeah, thanks.